Hi, welcome back to the Personal Finance course. This is a chapter called Real Estate and Other Alternatives. I'm Tom Mihawk, and this is section 2 of this chapter, and we're going to talk about taxes and real estate. Now, taxes are you are taxed on income received, usually annually at ordinary income rates. This is the higher of the rates that you can pay as an individual. Appreciation will be taxed as capital gains. So there's short-term gains, right? Less than 1 year, taxed at ordinary income rates. Now, why does the IRS do that? Well, they want to encourage you to invest long-term. And so they assess a higher rate. This is parallel to investments in securities too. But the point is that you pay a higher rate for investing shorter term. This is when you purchase a property and sell it in less than a year. For long-term gains, however, greater than investing where you own it and then sell it, and hold it longer than 1 year, you would pay 0% capital gains rates if your earnings are only $80,000, 15% capital gains rates from there to $496,600, and 20% capital gains rates if your earnings are above $496,600. These are your total earnings. This is you as an individual. So the point is you pay much lower taxes if you achieve capital gains treatment, and you pay less taxes if you own longer than 1 year, which would be considered a short-term capital gain. Capital gains taxes, in addition, can be deferred if you reinvest the sale proceeds in a similar or more valuable property. This is called a Section 1031 exchange or transfer. And so by taking the proceeds and investing in another property that's the same or more in value, you can defer those capital gains. Or they can potentially be avoided if you invest in an opportunity zone. An opportunity zone is designated by a government to develop underdeveloped areas, for example, maybe in a city or even in the suburbs or a rural area where the government seeks to attract investment to improve the lives of its residents and its economic stability or economic ability. Real estate investment entities. We talked earlier about real estate investment trusts. A REIT is a company that owns or finances income producing real estate. It has to meet certain requirements to qualify. REITs get a fair amount of tax preference, but they have to meet certain qualifications to get those tax preferences. They trade on major stock exchanges and offer through individual company stocks, mutual funds, or exchange traded funds a share of the income produced in the investment without having to buy, manage, or finance the property. It sounds pretty good, right? I mean, wouldn't you rather not have to do that for yourself? Now, clearly, if you do it for yourself, you make more money. You probably save more money, so you make more overall. But the point is that a real estate investment trust allows you to invest with experts, like investing in a mutual fund devoted just to real estate, but it has other special tax preferences that potentially could make your investment more attractive. You could invest in a mutual fund, as you can see in the next bullet. All the major investment firms, Vanguard, Fidelity, American funds, you name them, they all have real estate investment options. You can invest in private equity funds where you invest in a pool with other investors and they invest in private real estate. You could invest in limited partnerships where general partners assemble investors called limited partners, where the risk of those investors is limited only to their investment. They contribute a certain amount. In aggregate, they pool their money together to purchase real estate. They probably also borrow, as we talked about earlier, using leverage to leverage the amount of real estate they can control or purchase. General partners have more liability. If they make mistakes, if they're fraudulent, they could be sued and lose more than their investment, but they can also receive a gain greater than limited partners too. The limited partners pool together and create an investment that purchases real estate. And then also syndicates. A syndicate would be a group of people that were assembled just to invest in a particular project or a few properties called one project or a few projects even. That would be a syndicate. So why invest in real estate? First, diversification. It gives you a chance to reduce your risk for a similar return or raise your return for a similar risk. That's what diversification gets you. Remember the whole idea that it's it and other alternatives are uncorrelated to standard market indices like stocks and bonds, for example. The returns are uncorrelated with more common stocks and bonds. There are great tax benefits we've talked about, like depreciation, the ability to deduct expenses and things like that. Leverage is common. We talked about how leverage is used in residential real estate, in your personal home. Very common and may enhance returns. It might enhance risk too, but it can enhance returns. Income, if you own real estate, rent paid is you receive as income, and that's a great benefit. And lastly, appreciation. You may save money renting over, even with a similar size property, similarly located, convenient to transportation, but it doesn't appreciate. You can't paint your kitchen, you can't put in a new bedroom or new closets if you want. You could paint the kitchen, but you have to paint it back to the white that it was when the way it was painted when you moved in. So they're great. These are great opportunities in real estate. And how to invest in real estate directly by owning your own home, a vacation home, or income producing properties that are residences of others. Could be commercial properties too that you own and receive rents. So these are direct investments. You own the investment directly. Invest carefully. If you're investing directly, make sure to learn best practices. Learn the tax strategies. Cultivate tax and legal advisors. Develop your personal knowledge. Network with contractors and real estate sales professionals. The less expensive it costs you to renovate a property using a contractor you know and trust, the better it is for you. The faster you can sell a property because you know the real estate professional, know their resources, know how fast they can find buyers, the better it is for you. Alternatives in general benefit those who are knowledgeable. All investments do, but alternatives in general increasingly put more emphasis on knowledge of the investment. And real estate, that's certainly true. Many people gain that knowledge for investing in their own home, but investing in private residences, commercial property, those kinds of things, you have to take an interest, know that market, talk to others who are doing it, grow your knowledge so that you can understand what your opportunities are and take advantage when things happen that are maybe unexpected. And last, indirect investments may be less risky, like real estate investment trusts, mutual funds, and exchange traded funds. They probably offer lower returns too, but less risk because you're hiring a professional, you're getting more diversification within each pool as well. Now, let's go on to other alternatives. This slide shows the cover of the 2018 Yale Endowment newsletter, and it's page 1 or 2, which shows their endowment highlights. Notice that in 2018, the market value of their endowment portfolio was $29.4 billion, and the return they produced 12.3%, pretty high. 11.3% the year before. I'm going left to right. Notice in 2014, the portfolio value was almost $24 billion. And its return was 20.2%. Phenomenal return. Now notice what they invested in. Now, by the way, I chose this one, the Yale Endowment, for a reason, because its head, David Swensen, has been investing in alternatives for, well, since 1990, I believe. So look at their investments. Absolute return, which is a type of alternative investment designed to produce returns in all market environments, not just when the market's going up, but also when markets are going down. Domestic equity, that's U.S. stocks. Fixed income, U.S. bonds. Foreign equity, that describes itself. Leveraged buyouts are a type of private equity that uses borrowing, leverage, to acquire properties. It's sort of the old term at first. Well, I became most aware of it in the 1980s, but it's a specific kind of private equity investing. Natural resources invests in raw land, oil and gas, lumber. Real estate invests in just what we just talked about, residences, commercial, industrial properties, probably raw land too. Venture capital, we're going to talk about in a few slides. And cash, which is just money in the money markets or at a bank or something like that. But look at their percentages. Notice that in 2018, in absolute return category, 26% of their investment. Look at their domestic equity, 3.5. This is U.S. stocks. In general, endowments used to invest 60% in stocks, 40 or 35 in bonds, and 5% in cash. Well, they've invested only 3.5%. This is down from 3.9% in U.S. stocks in 2014. Look at their investments in leveraged buyouts, 14.1%, venture capital, 19%. I'm looking at 2018 again. And so David Swensen really pioneered this approach of using alternatives so that they produce a diversified portfolio of uncorrelated returns that can provide returns in a wide variety of markets. He hasn't been successful every year. Notice in 2016 the return produced was 3.4%. But in general, they've had a very high average rate of return over a long time. Let's talk about private equity. Private equity is the purchase of privately owned companies. The assembler of the portfolio is trying to grow these companies, expand and improve operations, refinance to create better capital structures. By growing the company, it might mean expanding internationally. It might mean expanding into new markets. Operational improvement might mean reducing redundancies, consolidating into one home office, or changing their accounting systems or those kinds of things. Returns, investors receive their returns when the private companies are sold or taken public, and that provides a liquidation event, and those proceeds are then distributed to investors in the portfolios. What the investor experiences, they first make a commitment to the portfolio. I'm going to invest $500,000 in the portfolio. Funds are required to be sent to the investment when they're called. So as the fund finds and makes investments, it makes a call. And so if you commit to $500,000 and they make a 10% call, you're required to send a check for $50,000. You don't send it all up front like you would invest in a mutual fund. You make investments as your money is called. And then when these companies are sold or taken public, you receive distributions on occasion. You should think in terms of a long time frame for your investment in private equity. It might be 10 years, maybe more. One I've been invested in was 10 years. And so capital calls were made over roughly 10 years, maybe a little less than that, but roughly 10. And capital was then distributed over 10, maybe even a little more than that. And it comes, you don't know when the capital is going to be distributed in general. The company may give you some foresight, but you don't always know. Good returns would be 20% or greater, let's say. Moderate returns would be 12 to 20, less than probably 12 would be, or 10 would be considered, poor. And some private equity funds produce returns much greater than 20. But somewhere around 20 and greater would be considered very good. Fees are typically high, 2% on commitments and 20% on profits. This structure, called a 2 and 20 structure, means that you make a commitment of $500,000. You haven't even funded all your calls yet. You haven't even invested all your money yet, but you still pay 2% on your entire commitment. And then when profits are created, you pay 20% on those profits. So if a profit on your $100,000 investment, this initial one, for example, is, let's say it's another $100,000, you would pay 20% or $20,000 of those profits. Now there also may be a hurdle rate or a high water mark or something like that. And the return has to exceed a certain amount before this 20% is paid. But clearly, if you invested $100,000 and were receiving that and $100,000 gain back, they would have exceeded any reasonable hurdle. So this is called a 2 and 20 fee structure. 2% on your commitment, 20% on profits generated. And then, generally speaking, these investments, this private equity investment, are for accredited investors, meaning individuals with income of $200,000 or greater, or married couples with income of $300,000. There are other criteria, a wide variety of them, but this is a summary hurdle. Individuals, income of $200,000, married couples, $300,000. And as I said earlier, private equity and other alternatives are being made available to a wider range of investors. But in general, these have been available for accredited investors. That's the end of section 2, and we're going to take a break, and we'll come back with section 3.